Today, we are going to unpack a massive, and I mean massive, financial shift that's happening pretty much under the radar. It's all about China, the global financial system, and a number so big it's honestly hard to wrap your head around. Now, this isn't some wild future prediction. Nope, this is about a pattern that's unfolding right in front of us. And understanding it, it's absolutely crucial. Think of it as a high-stakes game of financial chess, and the pieces are moving right now. So let's break down the playbook. $8 trillion. Just let that number sink in for a second. That's the scale of what we're talking about here. To put that into perspective for you, that is bigger than the entire yearly economic output of Germany. It's bigger than Japan's GDP. It's more than the GDP of every single country in Africa, combined. This isn't just one transaction. It's a quiet, coordinated shift of reserves, of assets, and of the very plumbing that makes global finance work. This quote, it just nails what we're talking about today. Look, this isn't some clickbait doomsday video. What we're doing here is pattern recognition. We're watching how leverage gets built up, how alternative systems get constructed, and how that cozy economic interdependence can suddenly be turned into a weapon. This is the stuff you really need to understand. At the very heart of all this is a recurring playbook. It's a four-stage pattern that pops up again and again throughout history whenever a rising economic power starts to challenge an established one. It's kind of like a hidden choreography, and once you see it, you'll start seeing it everywhere. So here they are, the four stages. It all moves from what looks like a win-win partnership to, well, a potential high-stakes showdown. We start with dual dependency, then move to asymmetric accumulation, then strategic repositioning, and finally the potential last stage, controlled demolition. Let's walk through each one so you can see how this all clicks together. All right, stage one. This is the honeymoon phase, right? Two economies get closer, supply chains merge, money is flowing back and forth, and hey, everybody's getting rich. You hear politicians giving speeches about cooperation, and economists publish papers about how conflict is totally irrational because, hey, we're all too connected to fight. And you know what? That always sounds smart right up until it isn't. And that leads right into stage two, where the leverage starts to shift almost without anyone noticing. The nation with the surplus, that's the challenger, they quietly start building up their reserves, their industrial power. They're building options for themselves. Meanwhile, the nation with the deficit, the incumbent, they're building up debt, fragility, and dependence. It all feels like business as usual, but under the surface, the whole balance of power is changing. Which brings us to stage three, the quiet phase. And this is where it gets really interesting. The challenger keeps smiling and shaking hands in public, but in the background, they're methodically building exit ramps from the incumbent system. They're moving their reserves around, building their own payment systems, and securing their supply chains. It's a perfect example of how preparing for a potential conflict can look an awful lot like boring old risk management. And then you have stage four. If things get to this point, the challenger doesn't need to win a traditional war. They can just start pulling the financial levers they've spent decades building. They weaponize the very dependency they helped create to cause financial pain and get what they want politically. And all of a sudden, the incumbent realizes their own financial system has pressure points they never even thought to look for. So you might be thinking, okay, that's a neat theory, but is it just a theory? Not even close. To show you this isn't just some hypothesis, let's take a quick look at how this exact same choreography has played out before in history. First up, let's look at Britain and Germany way back in the early 1900s. Stage one, they had deep commercial ties. Seriously, everyone was convinced that all that trade made war impossible. Stage two, Germany massively built up its industrial strength. When conflict did arrive, the whole financial system just seized up. The key takeaway here is that the plumbing of finance itself became part of the battlefield. Okay, next up, America and Japan in the 1980s. Stage one was classic integration. Then came stage two, where Japan piled up huge dollar reserves and US assets. And here's where we see that key dynamic. The surplus country, Japan, got more options. The deficit country, the US, got more exposure. Stage three showed up with the Plaza Accord, which basically proved that when the leverage shifts, currencies become about power, not just free markets. And for a much more recent example, just look at Europe and Russia. Stage one, deep energy dependence. Stage two, Russia built up its financial reserves. And then, when the conflict in Ukraine kicked off, Europe's dependency became a weapon that was used against it. What looked like a smart, efficient move in peacetime, buying the cheapest gas, it turned into a massive vulnerability when things got real. Okay, So with all that history in our back pocket, let's apply this exact pattern to the US-China relationship and see where we stand today. And wow, the timeline just lines up perfectly. Stage 1, from the 90s to about 2010, was all about integration. Everybody won, and everybody thought this was the new normal. Then Stage 2, from 2010 to 2020, was all about accumulation, as China built up this immense leverage in global supply chains and finance. And now, we are deep, deep inside Stage 3, repositioning. And look, this isn't just speculation. You can see the receipts. They're cutting back on U.S. government debt, which could give them leverage over American interest rates. They're building their own payment system, CIPS, to get around the Western-controlled system and protect themselves from sanctions. They're working on a digital currency. They're buying up gold. Each of these, on its own, seems like a dry, pretty boring financial adjustment. But when you put them all together, it's the unmistakable footprint of Stage 3. This chart here really shows the strategy perfectly. You've got the dominant SWIFT network versus China's CIPS system. Now, CIPS doesn't need to replace SWIFT to be a game changer. It just has to exist as a workable escape hatch, a backup plan that makes China less vulnerable to sanctions and gives them a huge bargaining chip. So if China is well into Stage 3, what could Stage 4 actually look like? Now let me be clear, this isn't a prophecy. This is about exploring the potential levers that have already been built and put on the table. Let's think about 3 main ways they could apply pressure. First, financial tightening. Imagine a rapid sell-off of U.S. bonds to spike interest rates and create chaos in the markets, right when it would hurt the most. Second, targeted supply chain disruption. We're not talking a total shutdown, but maybe a sudden quality control inspection that just happens to halt the export of one critical component that a major industry can't live without. And third, offering their alternative system. Basically saying, you're cut off from our markets unless you agree to do this deal in our currency using our payment system. A crisis like this probably wouldn't be a single-day crash. It would be more like a cascade. Week 1, the markets start to smell trouble. Week 2, some policy move confirms it's for real. Week 3, the financial plumbing starts to creak and groan. By week 4, yeah, policymakers are reacting, but confidence, which is the most important currency of all, is shaken. And that's how you see a financial crisis and a supply chain crisis start to feed on each other. So the most important question is, what do we do with all this? How are we supposed to think about risk and resilience in a world where the financial rulebook is clearly being rewritten? Well, first, we have to challenge some old, comfortable assumptions. That idea that mutual dependence prevents conflict? Nope. The hard reality is it creates leverage. The belief that the US dollar is too big to fail? Its status is not a law of physics. Alternatives are actively being built. And the assumption that America can just flip a switch and respond? Rebuilding industrial capacity takes years, not months. So, in a world where an $8 trillion repositioning is happening, resilience is everything. You have to expect more volatility. You have to know where your own weak spots are, especially with supply chains. You should be looking for who benefits in this new world. Think companies focused on domestic manufacturing, automation, real resilience. And maybe most importantly, you need to diversify your assumptions, not just your assets. And start watching the right signals, the boring stuff, the plumbing, not just the daily headlines. And all of this leaves us with one final big question to think about. The world is becoming more strategic, it's more fragmented, and it's way more prone to shocks. So are you positioned for the smooth, predictable world of the past, or for the strategic one that's emerging right now? Because how you answer that will likely determine whether a shock is just a headline you watch on the news or a wave that sweeps you away.